and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie at the Bloomberg Tech Summit here in central London. Here are today's top stories. European stocks are mixed, with bonds extending a global sell-off. That's as traders weigh a slower pace of US interest rate cuts. Secretary of State Antony Blinken makes an 11th visit to the Middle East as the US renews its push for a ceasefire between Israel and Iran-backed militants. Shares in SAP jumped the most since July as cloud revenue soars at Europe's biggest software company. And we're going to be speaking to the CEO of another European tech giant shortly as we hear from Christophe Fouquet, the CEO of ASML. Let's check in on the markets then. Yes, a reassessment in terms of the Fed's next steps leading to that global bond sell-off. We saw a marked jump in yields yesterday across US Treasuries. Here's the read across then, across your equities space. US futures currently pointing lower by 0.2% after modest losses yesterday. Nasdaq 100 futures pointing to a drop of 50 points at this moment. European stocks currently off by 0.2% across the European stock 600, the benchmark, of course. On your yield space then, at the front end, the US two-year Treasury currently yielding you 4.04 with a move of just 1 basis point in the session today. 150.96 currently on the Japanese yen. We've seen some softness in the Japanese currency, down about 5% in the last 30 days or so as we build up to that election and vote out of Japan over the weekend. Brent trading at 73.88, down 0.5% in the session. Gold up again so far in the session, up 0.5%. Another positive day for the yellow metal, trading at 2,733 per troy ounce. Now, Wall Street veteran Ed Yardeni says the best election outcome for US equities would be an impasse that leaves neither party with a dominant position. He also spoke on the Treasury market, calling for US 10-year yields to rise to 4.5%, but he says they could reach 5% if either party wins a sweeping victory.
I think if we do get a sweep by the Democrats or the Republicans, it almost doesn't matter. Either way, we're going to have wider deficits, more debt accumulating, and possibly inflationary consequences.
Okay, for more, let's bring in Bloomberg's Valerie Teitel to get assessment of how the markets are digesting these evolving views on the bond market. Valerie, is it a worry then over deficits driving the Treasury market, or the commentary we've been hearing from FOMC officials?
Look, Tom, it was very interesting to hear from Ed Yardeni just there in that video talking. It doesn't matter who wins the election. If it's a sweep either way, the deficit is going to grow, and he sees 10-year yields. They could reach 5% if we do get a sweep by either party. It was a bruising session for the bond market yesterday, but even today we are still ticking higher in yield. We're now up over 12 basis points in the 10-year sector, but a lot of questions over what drive this. Is it the Trump trade? Is it the Fed speakers we heard yesterday? Is it this worry about deficits? If you change on to my next chart, I just want to show you how this Trump trade has evolved over the last few weeks since the end of September. This blue line here is the betting odds of a Trump win. You can see as they have grinded higher, predicting more of a chance of a Trump win, we are seeing a stronger dollar, and we're seeing those U.S. yields head higher. So perhaps it's the Trump trade leading the markets at the moment. We're now 14 days away from that U.S. election.
Yeah, indeed, the countdown is on, isn't it? The Trump trade seemed to overshadow the views coming through from some of these FOMC officials, as you say. How has the Fed pricing adjusted then? We have the likes of Apollo coming up, Torsten Stock saying, maybe the Fed just pauses in November. How is that kind of expectation being built into market views?
Yeah, it was interesting to hear from Apollo's Torsten Stock talking about a November pause. But if you look at the pricing of what's going on in the market, we are still easing and taking out all these expectations for a Fed cut. It was only just a few weeks ago we were pricing in 2 back-to-back 25 basis point rate reductions from the Fed. But as you see here, we're now pricing in only 40 basis points of cuts throughout year end, 22 basis points for this meeting in November, and only 17 basis points for that meeting in December. The expectation is, as we continue to get this hot string of U.S. data, perhaps the Fed doesn't need to cut as aggressively.
Okay, so if November is not in the balance, then December certainly is Bloomberg's Valley Titel with a breakdown across these markets and how things are being adjusted around Fed expectations. Valerie, thank you. To the corporate conversation, the earnings story right now. S&P, SAP getting a boost in the session today and helping to lift the DAX into positive territory. You can see the SAP, that stock jumping more than 5% on the back of the earnings story, of course, out of the third quarter that came in roughly in terms of the cloud revenue for SAP, now the biggest software maker by market cap in Europe. SAP's Q3 revenues coming in an increase of 25%. The other tailwinds for SAP then are the fact that they have these forward view, 12 months into the future in terms of commitments around bookings, and that saw an increase of 25% as well. Interestingly, SAP also raised their outlook for cash coming through in terms of the longer term for the year, up to 4 billion euros on that front as well. Cloud revenues, by the way, they're guiding that up to around 27% at the high end in terms of cloud revenues. The CEO saying yesterday that about 30% of the demand coming through in the third quarter from their customers did have that AI link. So customers wanting some of those AI analytics and services that SAP provides. And the CFO telling me today he sees that gradually improving as well in the months and quarters ahead. Interestingly, this is a company that's seen its market cap increase by about 100 billion euros year to date. And that is proving some problems in terms of its market weight on the DAX. They're bumping up against that 15% limit and that cap that's imposed by German authorities. And the CFO telling me he'd quite like to see that removed. The stock up more than 50% now year to date. SAP then with that look and outlook in terms of the demand coming through with cloud services as they push further into the subscription model from the licensing model, and that is starting to pay off as well. We're going to hear as well from some of that conversation with the CFO of SAP. I was speaking to him earlier. Take a listen.
We would like to see that kind of 15% cap disappear because it constrains a little bit the demand in Germany. But we are really focusing on the large pools of capital available in the United States. There's still a lot of runway, a lot of room for us to grow and attract new investors. We would like not to exit Germany, but to the contrary, attract capital into Germany. And on that front, I have to agree the 15% cap in the DAX is not very helpful.
Okay, the CFO of SAP speaking to me earlier saying, look, he wants to attract more capital into the German markets. He's not considering delisting and listing in the US, for example. Wants to continue to attract that capital into Germany, but wants to see that cap removed, or at least, at the very least, adjusted, as the market cap of that company is plus 260 billion euros right now. Let's stay on the tech space and pivot to the conversation, the news out of Qualcomm, of course, the chip maker, so essential, particularly to those non-Apple iPhones. And the news reported from Bloomberg that they are developing and have unveiled a new smartphone chip. This is an adjustment to its own designs. Pre-market, the stock just off 0.3%. We'll see how that changes through the session. But again, an update and a reminder of the fact that Qualcomm is trying, at least on some measures, to be less dependent on the kind of architecture and designs from ARM. And we're going to be hearing from the ARM CEO, René Haas, later in the day from the Bloomberg Technology Summit. Let's bring you up to speed on some other stories making news so far this Tuesday. China is on track to become the largest market for Russia's pipeline gas this year. That's after Europe cut imports following the invasion of Ukraine. Bloomberg calculations indicate Russia exported 23 billion cubic meters of natural gas to China in the first 9 months of 2024. That's nearly 40% more than a year ago. The UK, meanwhile, is to loan Ukraine £2.3 billion to purchase military equipment paid for by profits generated by frozen Russian assets. The funding comes as part of a wider $50 billion package from G7 nations and the EU announced back in June. G7 allies have collectively frozen about $280 billion of Russian central bank assets, with the majority in Europe. Italy's government has passed a new law to overcome a court ruling that blocked the Prime Minister's plan to send asylum seekers to Albania. 12 migrants were returned last week after a court said they originated from countries that could not be recognised as safe. Italy's cabinet has now approved a list of 19 so-called safe countries to allow the plan to continue. And the new CEO of Prosus says adjusted profit at its e-commerce division is expected to surge more than 950% this fiscal year. Fabrizio Bloisi told Bloomberg he's deploying artificial intelligence across the business as he reshapes a complicated business legacy. We're going to hear more from him later on in the show. But let's cross over right now. Let's bring you that conversation live with the CEO of ASML, Christophe Fouquet, speaking to Bloomberg's Tom Giles. We can listen in now after that surprise cut to the outlook from ASML.
Around the world. But last week you had to do some expectation resetting in terms of bookings, in terms of your outlook for 2025. And how long the chip recovery will extend. You said on the call today, without AI, the market would be very sad, if you ask me. That definitely spread some sadness in the market, in the stock price. Could you give us a sense, when you talked about the new expectations, you focused on a couple of things, some of your customers like Samsung and Intel, but also China. And so I'm wondering if you could give us a sense of, on balance, how much of your resetting of expectations was related to changes in China versus weakness in some of the large customers that I mentioned?
Yeah, so I think last week we said a few things. And I think the first thing we said was that we still see AI as a huge opportunity for the industry. And we still see even upside on the short term. So I think AI has been with us now for a couple of years, and it's created a lot of excitement. And like all our peers in the industry, I do believe that AI will bring a tremendous opportunity for this industry. So that's the first thing we have said. So I said on the long term, AI is going to build up a real strong opportunity for the industry. Now, on the short term, I think you're aware of that. Not everyone is surfing yet on the AI wave. I think some companies have been doing extremely well. Of course, NVIDIA comes to mind, TSMC, because they are providing the first one, the product, the second one, the process that is going to manufacture the product. So they're very strong. I think you see, and I'm sure you will see that in the weeks to come, a very, very strong demand. Now, what we also said is that not every semiconductor manufacturer is involved in AI. Some of them are doing chips for more traditional application, mobile, PC, automotive. And that part of the market is not, recovering as quickly as we hoped.
Right.
And it does recover, so we see progress, and people are reporting that. But it's slower maybe than a lot of us expected. And I would say that concerns quite a few companies. All the companies, in fact, that today are not directly benefiting from the AI boost. That's a bit the split of the market we see today, at least.
Does that mean that we shouldn't expect a full recovery until 2026?
Well, that's always very difficult to say because, this is something we watch every quarter. Last week people were maybe a bit disappointed that we didn't give more heads up. But that's something we just keep watching. And, in the last 3 months, for example, we have seen that people were starting to push the brake. When do they start to push the accelerator again? We don't know because, when you become cautious, it usually takes a bit of time before you look at the longer term again. But, long term, we see growth. We see tremendous opportunity, which means that at some point of time, this has to come. 2025, by the way, we still see as a growth year for the industry, for ASML. The growth is not as high as I think a lot of people expected by then, but still a growth year. We also expect 26 to be a growth year, but it's too early to quantify that in very high accuracy or very high precision.
Got it. I want to talk a little bit about China. At one stage, they accounted for almost half of total revenue. What you shared with the market was that we have to think about China in its more historical perspective, where it accounted for something more like 20% of total revenue for you as a company. I'd like to get a sense from you of how much of that changing viewpoint on China is coming from weakness internally versus limits on what Chinese manufacturers can buy given export controls?
Yeah, so maybe first a step back. If you look at China, we just talked about AI. AI is the very advanced semiconductor manufacturing, very advanced chips. China, for a few years now, is focusing on what we call mainstream semiconductor. So semiconductor, we used to talk about IoT, all those chips that you have in all the product, making those products smarter. That's the type of chips China is basically manufacturing today. One part of the reason for that is, of course, the restriction that have been applied on EUV, as you know, which have prevented China to move to very advanced node. So the focus of China is on mainstream semiconductor. Right. The demand for that has boomed in 2021-22. As a result, the demand we had in China in 2021-22 has boomed as well. And 21-22 was the time, if you recall, where the demand was extremely high and ASML was struggling to deliver tools to everyone. Therefore, we couldn't deliver a large part of the demand in China. Backlog in China grew. 2023, the rest of the market softened. We got tools we could ship to China. Same in 2024. So the level of business we had with China in 23-24 was more of a result of the non-deliver capacity in 22-21 than anything else. And we have always explained that our quarter at 50% of the business in China, almost 50%, this was not normal. This was a peak resulting from basically a lack of delivery before.
Right.
The normal business in China is around 20-25%. Right. And that's the normal demand related to mainstream semiconductor. And I think we're going to go back to those numbers over time.
But there is something artificial about the way we think about China as a purchaser of equipment like ASML's, in the sense that many countries around the world, the US principally, have been exerting export controls on the country. Are those controls going to become even more stringent? For example, China is not able to buy your most advanced machines. Is it possible that those restrictions could extend to the DUV level, which is used for more mainstream products?
Yeah, so if you go back to the root cause, or I would say the prime motivation of export control, it was to prevent China to have access to advanced technology. EUV is not in China. By not having EUV in China, we pretty much stop the ability of China to go beyond the 5, maybe 3 nanometer node. They may be able to do a few chips, and you may see some of that in the press, because of course everyone is watching very carefully. But fundamentally, by not having EUV, we have placed China, the regulation have placed China, I would say 10 to 15 years behind when it comes to advanced technology. We always talk about China, we usually forget to mention the fact that while those restrictions have applied on China on EUV, a lot of work has been done with other players in the industry, Intel, TSMC, Samsung, on the most advanced EUV technology, as we know it today, INA, etc., etc. So there's been a lot of work done every single day to continue to widen, if you want, this technology gap. And EUV is a key element to be able to do advanced technology. Right. I think Intel has proven to the world a few years ago that without EUV, life was getting impossible. That's also true for China. So this limits part of the activity there.
Based on your interaction with the Prime Minister of the Netherlands, with the Foreign Ministry, is it your expectation that the restrictions will become even more limiting on China's ability to purchase machinery like ASML's?
Well, if you look at the geopolitical landscape, I think it's clear that the United States will continue to apply pressure on their ally for more restriction. Now the discussion we have with the Dutch Prime Minister, with, I would say, the European political leader, because at the end of the day we are a European technology champion company, right? So these are the people we have this discussion with. And the question is, what is right for the Netherlands? What is right for Europe? And as a result, what is right for ASML? So what restriction makes sense when it comes to national security, which has been the prime argument, and where does it stop, right? Because, like I say, a lot of the focus in China today is on mainstream semiconductor. And this is very different from, AI. So that's the discussion we have. I think the pressure will continue to be there because, if you look at the landscape, that's what it is. But I think that the discussion will get more sophisticated over time. The stake will become higher. And I think that countries like the Netherlands, all of Europe, where again we belong to, will also more and more start to discuss what makes sense for us.
Does it make sense for the European Union to work in such close concert with the US in making it difficult for China to get access to these machines? At what stage, and do you find yourself wishing that the Dutch government and maybe the EU government would push back harder on some of the restrictions that the US would like you to impose?
Well, I think, as a European citizen, right, Dutch, I would say resident, not citizen, as you know, I like to know that they do what is right for Europe and for the Netherlands. I think that's the most important things. We have always said in ASML, we don't make the law. Yeah, I'm not a politician. I don't know half of what they know, of course. And there may be good reason to restrict. And if there is a good reason to do so, and our government believes that, then we will go with it, of course. I think what's very important is to have the discussion with them so that they understand what we do, maybe understand the industry a bit better, and they are better equipped to really decide what is good, again, overall for European countries and for the Netherlands.
Based on your interaction with your customers in China and globally, is it your perception that the motivations for export controls are truly about national security interests and regional security interests versus economic competition? In other words, how much do you think this is about keeping China from becoming economically more competitive with the rest of the world versus these are legitimate security threats?
Yeah, so Tom, I could almost turn you back the question, right? You almost have a rhetoric question, I think, in here. And what you see happening is more and more people are asking themselves this exact question. And if you look at the press, I think there is a real debate happening. That's one of the debate. Is it really about national security? We know that there is, of course, a strong economic competition between, the US, Europe, China. We see it everywhere. People question how much of that has a play in the decision. The other debate you start to see, which I think is also related, is does it help us or does it hurt us? I think there's a lot of companies in the US that start to also question, is that a good thing for us? And I think that's the key debate to have, because, like I said, I think at the end of the day, we need our governments to do the right thing for their people. And I think those debates are far more, active, far more lively than they were 2 years ago. And I think it's very good. I think it's very good because most probably this brings us to what I will call a more rational discussion and a more balanced set of decisions moving forward. So I think we can only welcome debate in such complicated issues.
Thank you. I want to talk a little bit more. Let's bring things a little bit more local to the Netherlands, where ASML has discussed with the Dutch cabinet it wants to operate successfully in the country. Your predecessor, Wennick, said, if the Netherlands shuts down and we cannot get immigrants or foreign students, then fine, you should accept the consequences. Now, the Dutch government, to its credit, has set up a task force, said it will spend billions of euros in the Eindhoven region to keep ASML at home. My question is that enough, particularly in a world where there is a coalition led by a far-right lawmaker that's looking to implement the strictest ever anti-immigration policies. The cabinet's working on areas to restrict labor migration. You are dependent on labor from not just domestic, but around the world. How concerned are you about the forces at work bringing this anti-immigrant rhetoric and policy to the Dutch government?
Yeah, so here also maybe if you take a bit of a step back, I think that this is almost an issue for Europe, what you describe. As it's happening in the Netherlands, it's happening in many countries as we speak.
It's happening in the US.
It's happening in the US. And what we try to do, again, in our discussion with our government, every government wants to have company like ASML in Europe, in the Netherlands, right? Everyone wants that. The more, the better. But to be able to have a company like this, you need a few things. You need to have access to capital, access to people, access to energy. You need to have a place to build your factory. All those conditions have to be there. And if you want to compete with other countries, China, the US, whatever, not only you need to have those conditions, but those conditions have to be as good as possible so that you can be competitive. Because this industry is extremely competitive. And no one should ever take any success for granted, right? Of course, the story of ASML is great, but it's only great after 40 years of very hard work. And this is, something you have to preserve. So we need all those conditions to be there. I think, the Draghi report was also a good way to summarize what the entire industry in Europe think. And our government has to work on that. And, of course, there's a bit of, immigration is a bit of a topic of the day because that's a way to get people attention. And I think what we have said is we have built our company with more than 100 nationalities. So bringing talents from everywhere has been an absolute condition for success, and this has to continue. Now, the good news is, as you said, I think people are listening.
Okay.
And maybe when you get down to business, people are more reasonable than maybe when they run a campaign or try to get elected.
Does it make sense for ASML to consider locating or relocating some operations outside of the Netherlands as at least a contingency measure to ensure that you have access to those ingredients that you mentioned that over 40 years have made ASML a great company?
So the threshold to do that is pretty high for us because we are developing extremely sophisticated machines. Technology, in fact, is a combination of many, many technologies that we have to bring together. Our supply chain is 80% of it around the Netherlands, Germany, Netherlands, France, Italy, very close. Our R&D is now, of course, almost fully in the Netherlands. We have R&D center also in the US, but I would say the large part of it is in the Netherlands. And one very important thing is because of the complexity of our tools, we want to keep our research development very close to our manufacturing center. Because what you may not realize is every 2 years we make a new step on our machines, so we have to improve them every couple of years like our customer. And it means that every 2 years we build new machine. And we have to teach our manufacturing people very quickly to be able to build those new machines. So there's been a long lasting principle in ASML that we want to keep R&D and manufacturing together. And we'd like to do that in the Netherlands because this is where we are. So the threshold to change that, I think, is very high. And I would say new things like geopolitics give us even more reason to stay in the Netherlands so that we can build this very strong relationship with the Dutch government, with the European countries around us to also get the support of those governments in our activity.
So it's not really being considered now to maybe locate some operations elsewhere?
We have operation elsewhere.
Further.
But we will only grow those operations based on the activity we have in the different countries. But we don't at all consider to move a large part of our operation outside of the Netherlands. Not at all.
European Union has a tens of billions of dollars plan to expand local manufacturing capacity with the goal of doubling output from the region to 20% of the global market by 2030. In your estimation, is this a realistic expectation? And what are some of the hurdles that the region needs to overcome? This is the idea of increasing the region's capacity to be a bigger producer of chips to the global market.
Yeah, so I think it's very simple. If you want to achieve this kind of target, you have to build capacity. If we look at, for example, where we ship our system today, most of our system, 80% of our system, are still being shipped to Asia. So Asia remains, at least for quite a few years, I would say the key manufacturing place for semiconductor. To get to 30% share of the output, you have to take more than 30% of the tools that are going to be shipped. We don't see that yet, so I think that most probably the progress is not as fast as some people hope. I think you have also heard, of course, some major delay, right, in some of the factory in the US. So this is pointing to most probably a slower execution. But, you only can start to believe the target will be achieved when the capacity built is exceeding 30% of the total worldwide capacity, which is not the case yet.
In our introduction, Caroline reminded us that we have an election in the US in a couple of weeks. You might have heard about it. It's very close so far in the polls, but would you expect conditions for the global chip making world to become better under one candidate versus the other in the US?
Well, there's a lot of course, like everyone else, I follow the election in the US, and you can see a lot of polarization, I think, in the debates. There's one topic that still is, I would say, shared by both sides in the US. It's China. That's one, I think, one element of agreement. So we don't expect major changes there. We expect the pressure on export control on China to remain. To tell you exactly how this will play out, I really don't know, to be honest. I think
Do you think it'll be ratcheted up? Do you think that pressure will be, you talked about it's going to remain. Do you expect it to be ratcheted up?
I think, I told you the pressure will be there. After, I don't know, it's speculation if, one candidate may want to do more than the other. I don't know. But like I said, that most probably will not come without a debate. And I think that, this is what we've seen happening now for a few months. But we'll see.
At Bloomberg Tech, we like to talk about new products. You've got a new one coming out, high NA EUV. We showed an image of it earlier, $380 million. One of our sizes and scopes, it's the size of a bus or a size of a small Amsterdam flat. Some of ASML's customers have raised concerns about the price tag. One SVP at a major customer said, I like the high NA EUV's capability. I don't like the sticker price. Are you concerned that the price tag could affect demand for it? And I'm asking this of someone who has about 100% market share in this, so I understand that.
No, so, I had the question many, many times in the last few months, and I always gave the simple answer. We never build a product in ASML with the idea that the new product would be more expensive than the previous one. Of course, the price is higher, but the price of all our product has been higher over time. And the reason for that is that the value they bring is even higher. So I think the reason why we make high-NA is basically to enable customer to look at new design, so to create more flexibility, to look at the ability to go down another 2, 3, 4 nodes, which for this industry, at the end of the day, is the highest value we can ever generate. Someone, a customer told me, AI can happen today because we have this 3 nanometer node. We couldn't do AI with the previous node because this would have been too expensive, this would have been too much energy consumption. And in fact, for AI to really span out in all applications like we all dream of, there'll be a need of another 2-3 nodes to make sure that the cost goes down, to make sure that the energy consumption goes down. INA is going to contribute to that. You know, what we dream of in ASML for the next 5-10 years is going to contribute to that. And the value of INA is to continue to enable Moore's law to go with, of course, nowadays a bunch of other technology. But this is huge value. You know, I was also discussing with Caroline, who say, you know, AI is coming, it came, you know, like it's a big bang, right? And we know that as long as we continue to drive the industry, there will be another big bang at some point, which no one can even start to dream of. But this has been the story of this industry, and this is what INA is going to contribute to, right? So customer will adopt INA when the value of it is right, and they will continue to use all the other lithography product, of course, at the same time.
My last question for you before I let you go. We saw during the pandemic what can happen when we lose control over the supply chain. Do you feel like it would be necessary for ASML to somehow use its cash pile to do more to gain control over the supply chain, have a little bit more power in decision making, whether that would be making acquisitions or increasing the stake in one of your suppliers, such as Zeiss?
Yeah, so it's a very good question, by the way, because, you know, we said the market is going to be a bit less than we expected in 25. At the same time, we are continuing to build the capability we were missing in 2022. So that part, ASML has not stopped, because it takes time to do that. And we have, of course, had those discussions with our suppliers. Most of our suppliers are partners. Zeiss is a true partner. Right. They understand our industry how much as we do. We call the relationship with Zeiss 2 company, 1 business. I mean, the business is the same, and we still have a bit our different ways to do things. What I'm trying to say is that for most of our suppliers, we have a very strong alignment to make sure that we can meet the supply challenge of the industry. Only in very rare exception, we are acquiring some of the suppliers. The reason for that is usually if they cannot scale fast enough, if they cannot invest to the level we need them to invest. I think Cymer was a good example of that. When Cymer had to develop EUV, this was just too much too quickly. Therefore, we brought them in. We have another few examples, but that's the exception. We try to keep the supply chain separated because this allows us, if they deliver as we need, to be a lot more agile on our product and with our customers. So the model is very powerful, we believe.
Christophe, thanks for being with us today. Please join me in thanking ASML CEO Christophe Fouquet. Thank you so much.
Okay, Christophe Fouquet, the CEO of ASML, speaking to Bloomberg's senior executive editor for global technology, Tom Juss, here at the Bloomberg Technology Summit in central London, talking again, reiterating his views on the huge opportunity he describes around artificial intelligence, but really interesting on China and expectations that whoever is in the White House come January of 2025, the pressure for additional restrictions on China is likely to increase. That's the view from the CEO of ASML. Also talking about meeting that backlog that had built up from orders of 2021, 2022 from China and how that made them and pushed up the revenue stream, the sales into 2023. That is starting to slow now. And again, pointing to the softness in the demand for customers that produce chips for the auto sector, PCs and industrials. Coming up, an upbeat market outlook from JPMorgan Asset Management. The company's head of global multi-asset strategy joins Guy Johnson to discuss why they're so bullish about 2025. That is next. This is Bloomberg.
Welcome back. You're watching The Pulse. I'm Guy Johnson. Before the break, Tom McKenzie was talking about the AI trade. We'll be back there in just a moment. Let me assure you of that. But let's talk about the bigger picture and how that AI story folds into the wider narrative. JPMorgan Asset Management has published an optimistic outlook for its long-term capital markets predictions. It does this every year. It's, I think, the 29th report that we've seen out of JPMorgan on this subject. This is the report for 2025. It talks about a strong and even buoyant economy, global economy that's going to emerge. This as investment levels pick up and rates start to normalise. One of the authors that puts this together is John Bilton, JPMorgan Asset Management's head of global multi-asset strategy. And he's sitting around the table with me this morning. Nice to see you.
Yeah, morning.
So I think I talked to you this time last year about this, the 28th one. Let's talk about the 29th version of this. What's changed?
Well, I mean, if we took just the raw moves we've seen in markets this year, I mean, over 20% rally in the S&P, you'd expect the outlook would be a lot more dour. We'll have taken a lot of the returns from the future.
That's Scottish for bad, by the way.
That's Scottish for bad, it is.
Yeah.
But the point being that if we actually look today, we still see a pretty optimistic outlook because we've gone through with a fine-tooth comb. We've looked at where investment's happening from governments. We look at spending patterns. We look at AI and technology, which is just beginning to embed in the supply side of the economy. And actually that pushes up the earnings base and the growth base to a level that's, for the G7, the highest level in nominal growth terms that we've forecasted now since 2020. So fifth annual upgrade running to our growth expectations. And certainly seeing the way growth is getting delivered around the globe and especially in the US, that gives us confidence that there's still growth into these valuations that we've seen expand this year.
In the last year, the noise has been epic. The swings have been absolutely gargantuan. How can you see the signal in that noise?
Well, I mean, this is just the very point. We've got a market which is trying to calibrate to a new economic era. You know, we've gone past that new normal phase, that ultra-low interest rate phase, where really central bank activity goosed up asset markets, to one where we're actually seeing more investment in future productivity, both from fiscal spending from governments, talked about in the US, talked about here, even across the Eurozone with the Next Gen Fund. We're seeing more normal interest rates. We're seeing real interest rates that we expect to be positive. And that's beginning to build sort of growth rather than simply inflating asset prices. So actually having a focus on that as the market is trying to calibrate that shift from the old to this new world, we think is really, really important to do.
In terms of what that is going to mean, is it going to mean higher interest rates? Because there's another way of looking at investment, which is deficits.
Yeah.
Okay. Bigger deficits. Generally, the bond market doesn't like bigger deficits. Generally, the bond market prices higher yields, particularly at the longer end down the curve. Is that the scenario we're looking at here? Yes, we're going to be investing, but the cost of that is going to be a higher cost of money.
Well, you can try and come at the debt to GDP equation in one of two ways. You can either try and shrink the numerator or you can grow the denominator.
Yep.
We spent a decade trying to shrink the numerator and it didn't end well.
No.
You know, all we ended up with was rates below zero, real interest rates in the US at negative 1.5% throughout the period from the financial crisis to the pandemic. We're projecting around a positive rate of around 70 to 80 basis points going forward in real Fed funds. And that's more of a normalisation. And we're expecting that that's justified because the economy is stronger as we're seeing more fiscal involvement. We're seeing less need for central banks to do all the heavy lifting. And that's a healthier outlook. Typically, healthy economies should have neutral or positive interest rates, not deeply negative ones as we saw in the last decade or so.
So what am I going to get out of my 60-40? And is it going to be more than I'm getting out of my money market account?
Oh, yes. Oh, yes. Well, make no mistake about that. We're expecting out of cash, US dollar terms, 3.1% on average for the next decade. Sounds pretty good, but it's a long way down from the 5% today. A lot of reinvestment risk. 60-40, we think we get about 6.4% with a Sharpe ratio of about 0.3, 0.31. So for investing, actually, although it's come down from where it was a couple of years ago after we'd seen the sell-off in 2022, we're still looking at something which is smack bang in line with the last 25 years average from a global stock bond 60-40 in dollar terms.
If I want to juice that, how do I do it?
It's all about the alternatives markets. You know, 2 years ago, we saw that big reset in bond markets and stock markets. It was painful. Past couple of years, we've seen real assets remarked in private markets, real estate, etc. If you add in, an exposure to private equity, infrastructure, real estate and transportation, you take about 30% of your 60-40 and allocate it across there, you can push up that Sharpe ratio by a third to about 0.43, and you can boost your returns by about 80 basis points. And remember, our numbers are just for median manager. That's before you've started to layer in manager selection alpha.
Over at Goldman Sachs, David Costin's pretty convinced that the S&P's done. You're going to get a little bit of a boost now, maybe to the back end of this year, but then over the next 10 years, you're not going to get very much out of the S&P. It's basically priced in all of what you talked about already, and the asset price inflation is already in the market effectively, is what he's signalling. You want to take the other side of that trade?
We certainly do. I mean, David's a great guy. We love the work that they do. But at the end of the day, we see more positivity. You know, the expectation that the US economy is not going to be the globe's dominant economy.
Yeah.
And that we're not going to see the S&P 500, which has huge innovation, very strong revenue capture, and a very, very dynamic capital market behind it, and is designed for a digital economy, which is what's emerging today. How that doesn't capture the lion's share of returns, we struggle to see. Yes, you don't have the valuation support that markets like Europe, UK, Japan have today, but you certainly have huge reinvestment and huge upside in terms of returns. So we see about 6.7% expected return from S&P 500 over the next decade or so. And we think that actually when we look at that in volatility adjusted terms, it's still very much the core of the portfolio.
In 2 weeks' time, we've got an election in the United States. It's going to have a big impact over a significant chunk of your forecasting window, next 4 years. How big an impact could this election have on what you see in terms of what the outcome is going to look halfway through the 10-year kind of window you're looking at?
Well, when I think about it over our long term, we've got 3 elections that are going to be pretty significant over our forecast horizon, which is 10 to 15 years. But yes, of course, this one's going to be very important, as they always are. But the thing I would also note is if I look at cash returns versus a 60-40, following any geopolitical shock over the last 35 years, over 1 year horizon, 60-40 beats cash by an average of 8% 3/4 of the time. Over 3 years, it beats it by an average of 19% 100% of the time. So we've seen this movie before. Geopolitics is a fact of life, and we have to work through it. But ultimately, we're looking at a strong economy in the US, a catch-up play that we can see taking place in terms of government spending, strong private sector spending, and we think a much improved supply side to the global economy over the decade ahead.
John, it's always a pleasure working through this with you. Thank you very much indeed for bringing it to us. John Bilton, JPMorgan Asset Management's head of global multi-asset strategy. Coming up, more pressure on the European auto sector. Car sales falling in September, their first consecutive monthly decline in more than 2 years. The details are set to follow. This is Bloomberg.
Welcome back. Happy Tuesday. I'm Tom McKenzie at the Bloomberg Technology Summit here in central London. To the auto sector now. New car registrations in Europe fell more than 4% in September. That's compared to a year ago. At Stellantis, the owner, of course, of brands including Fiat and Peugeot, sales dropped 26% across the region. Let's bring in Bloomberg's global autos editor, Craig Trudell, for the details. Craig, were you surprised by this drop in sales?
Not necessarily. I think we've seen just in the last couple of months some softness for the European market. If there was a surprise here, it's that maybe that we've actually seen the battery electric vehicle sales trending in the wrong direction, and that being a big source of concern. And what we saw this past month was actually some firmness on that side of the market. Sales were up about 14%, which is a positive development for the car makers making this transition. But it was really, the weakness on other sides of the ledger that led to, this, first back-to-back decline in monthly sales since mid-2022.
Yeah, and particularly the numbers for Stellantis, as we mentioned, they were ugly indeed. But as you say, silver lining maybe when it comes to electric vehicle sales. This all in the run-up to a big earnings week in the auto sector. Craig, what are you and the team going to be looking for?
Yeah, I think today General Motors will sort of kick things off. I think, there's unlikely to be much in the way of surprise out of GM in that they just had an investor day and sort of signaled sort of what to look out for. I think this is largely a U.S.-driven story, and their pricing in that market has been extremely strong, and that will probably be a major point of emphasis. I think you mentioned Stellantis, concern about whether or not the fact that that company is going to have to sort of bend on pricing and discount in order to clear inventory, how disruptive that is for other automakers that report this week. Tesla, of course, tomorrow as well will be interesting, just in that, we have seen, some softness for their sales. They had some improvement in the latest quarter. But I think, one of the things that I'll be looking out most for from them is actually regulatory credits. So they sell credits to other automakers to help them comply with CO2 standards. That business is actually proving to have some real staying power as other automakers struggle with selling more EVs.
Okay, that's really interesting, Craig, on the regulatory credits for Tesla, what to scrutinize out of those earnings. Our Global Autos editor, Craig Trudell. Craig, thank you. Later today, we're going to have a conversation with the director of DeepMind, John Jumper, and the CEO of ARM, Rene Haas, as part of the Bloomberg Tech Conference that continues here in central London. Stay with us. This is Bloomberg.